Well, it's that time of the quarter where you start to get a lot of previews coming in from strategists all across the board, and one of the first few ones coming has been CLSA's Vikash Jain, who has written a report on the Q1 numbers. Now, when we look at the Q1 numbers, what he's expecting is this on record will be one of the worst quarters in terms of a YOY decline. No guesses to take that. It's because of the lockdown that happened in the month of April and May, which of course got extended, and then you have the unlock also where things were not particularly that great. So it's going to be a record decline. For CLSA Universe, they expect more than a 40% decline in the PBT. And I'm talking about PBT, this is before tax number, what they're looking at. And they're saying that domestic companies or companies which are highly linked to the domestic space will see much more in terms of a decline. In fact, they're expecting a decline of more than about 55% as far as some of these domestic companies go. Now, what the interesting part that they're saying is that some of the exporters are slightly immune. It's not that they will not see a decline, but they're slightly immune. So, IT as a pack is something which they believe would be relatively better than the overall universe. Pharma, where stocks have got re-rated, will be better than whole of the universe, and that's essentially broadly their view. But overall, all the sectors that they track, all the mid caps that they track, they are expecting a YOY decline as far as PBT goes. Now, in terms of sales front, also it'll be a PBT-led number which they are looking at, but it'll be a sales number which will lead the decline. Cost will be particularly high, and that in turn will lead to a decline. Now, the interesting bit that they are saying is that FY21, FY22 numbers are still elevated. They at CLSA believe that there will be a YOY decline, which will be much worse off than what the street is anticipating at this point of time. And that could be the reason, that they would look at in terms of what essentially they would do in terms of a EPS downgrade. So that's what they are saying, that consensus estimates for FY21, not only for Q1, seems to be elevated. For FY22 also, it seems to be elevated. And post Q1, you could have a decline on that front. Now, there are 3 or 4 things that they would be watching out for as far as management commentary is concerned, as far as numbers are concerned. So let's start with the management commentary first. Are things getting normalized? Are things in Q2 looking better than what they were in Q1? Is the demand coming back? So that's broadly what they are looking in terms of management commentary. Now, in terms of data to watch or events to watch, how are companies, especially consumer durable companies, preparing for that time of the year where we are essentially going into the festive season? So do they have enough supplies? Is there enough migrant labor? Migrant labor was an issue in the month of April. Have they started to come back? Are factories and various other dealers operating at normalcy levels, at least post 30th June? That's what they would be looking at in terms of commentary. One interesting number that they would look at in terms of what's happening with the moratorium bit, because remember in March end you got the moratorium number, which is of course extended till August, but the initial feelers that one is getting is that moratorium is reducing as a percentage of the loan book. So what's the moratorium number will be very, very important for the financial space. Moratorium number, management commentary, and are things returning back to normalcy is what the street would eye.